When we talk about building wealth, we assume that it's a lot about the returns that we will generate, about investing in stuff that grows disproportionately and so on, right? But the true trick to growing meaningful wealth is not to lose it. It's almost the exact opposite of what it takes not to lose money is very different from what it takes to make money. So as wealth managers, some of the folks who've made disproportionate amount of capital are those who in the worst of times have not lost meaningful amount of money.
It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. Robert Kiyosaki. Today on the 1% Project, I'm speaking to Sandeep Jethwani. Sandeep is the co founder of Dezerv. Dezerv is an expert led wealth creation platform that aims to deliver sustainable returns to its clients through its unique integrated portfolio approach. Dezerv was founded in 2021 and today it has 1,000 crores under management. In this engrossing conversation, Sandeep talks about his Dezerv journey, the role of patience in creating long term wealth, building a brand that consumers trust, the role of mentors, and much more. If you have any feedback about this conversation, speaker, or topic recommendations, you can drop me a line at pritish@1%.live. Subscribe to the show wherever you're listening to it and sign up to the 1% Project's newsletter at 1%.live to get the key insights and show notes from this conversation and every other conversation. Welcome, Sandeep, to the 1% Project.
Thank you, Pritish, for having me. Very excited to be here.
What is your counterintuitive insight about wealth management?
It's a good question. It's one of those things, Pritish, that you don't realize immediately. It's a realization that dawns on you. And it's got to do with a problem bigger than wealth management, actually, in my mind. For most things in life, Pritish, we want control on as human beings. You want control on what food you eat, you want control on what car you drive, etc. But the counterintuitive thing is, for the really important things in life, you want an expert on your side. It's interesting, right? Think about it. At one level, you're saying that human beings seek control. But when it comes to the most important things in their life, they want somebody else to handle it for them. Health, wealth are all a part of those most important things in life. And that's the one thing that I've realized, especially with people who mature over a period of time in terms of age, and the wealth quantum becomes larger. So it becomes more important in life. Size increases, assets increase. As it becomes more important, you seek out help and support. And that for me is something that going in and as we were starting Dezerv was not very obvious immediately. It came to us over a period of time.
How did you come up with the name?
Yeah, that was also a very interesting journey. So we had, when we were starting off, we had a working title in place. We were thinking of what we should call this. So the working title at that time was Coalition, because we said that we need to get good people together to build something meaningful in wealth. As we were thinking about the name, for me it was very clear that the name should resonate with the feeling of the user whom we are trying to serve. And one thing became very clear, that as you grow in life, as you get more money in life, you do deserve better than what you are getting when you did not have the capital. You are working really hard. The question is, your money working as hard as you are? And that is where the emotion that I, as somebody who's worked so hard and have got to a certain stage in life, deserve better than what I'm currently getting. Deserve for me was a sort of the sense of aspiration, the sense that we can do better with what we have and than what we have, I think was the reason why we went after Deserve. And obviously, the first question you ask is the domain name available in today's world, which is why we had a twist on the spelling itself. The S was replaced by a Z, dropped the E at the end, so it became DEZERV. And when we today talk to people, what we realize is two things. One is, it's a great conversation starter. People almost ask, similar to the way you've asked, that why did you call it Deserve? And when we give the answer, it almost resonates with their own presence. They want to be treated, valued differently. In India, especially, the upper middle class is emerging now. A lot of the folks that we work for actually have done significantly better than their previous generations ever did. And they have now access to the best opportunities, the best potential lifestyles. And I think this sort of keeps coming back to us, that they really are people who deserve much more than what they have today. So that's the story and the history behind the name, Pritish.
How should one think about building long-term wealth?
And again, here this is going to be slightly counterintuitive, Pritish. So, when we talk about building wealth, we assume that it's a lot about the returns that we will generate, about investing in stuff that grows disproportionately, and so on, right? But the true trick to growing meaningful wealth is not to lose it. It's almost the exact opposite of what it takes not to lose money, is very different from what it takes to make money. So, as wealth managers, some of the folks who've made disproportionate amount of capital are those who in the worst of times have not lost meaningful amount of money. So to me, the first thing that you would think about when you deploy capital in any asset, in any portfolio, any opportunity, is what is the worst case scenario in case the thesis does not play out the way I am assuming it to. And then it becomes very clearly about that if things go bad, if expectations don't play out, what is the potential damage that it could cause on the investment I've made? So, will it go down by 20%? Will it go down by 30%? The next question is that will I be able to tolerate it? So, if I'm able to tolerate it, then potentially for me to go into that asset probably makes sense, because then I can hold through the period when it is down. But often most people realize when they think about that maybe it's not for me and I shouldn't therefore do it. The key to generating long-term wealth is first be comfortable with how much money the asset can lose, and am I okay with it, and if I'm not, then don't do it. And why do I say that? When at the bottom of the asset cycle, when things are not going well, the portfolio is down, you're losing money, most investors will bail out just at potentially the worst time, and that is what then breaks compounding. So in some sense, what we are solving for is compounding. So in the long run, what is the biggest or the eighth wonder of the world, as they say it, is compounding, right? But what breaks compounding is if I exit the asset at the worst of times and I lose more money than I can handle. So optimizing for that downside or controlling for that downside is, to my mind, one of the most important things when we think about creating long-term wealth.
Where is India in its wealth creation journey, and how is deserve adding value to it?
I think that's an emotional question actually, because I get really excited about the Indian opportunity, Pritish. I think India hasn't seen wealth creation at all. When we look back at the time that we are here, so while we're recording it, this is 2022, when we look back at this 10 years later, we will think of the current time as a very low base from which India grew. So there are a couple of things that are happening. So at the very top, the quantum of wealth creation is dramatically different than what we have ever seen in our lifetimes. Now, wealth creation is happening at obviously people who own growth assets. So, promoters who own equity in their company. But for the first time, we are also seeing wealth creation happen at the middle class level through salaries, which had not happened before. Earlier, you had this thing that rich get richer. That was the common phrase. Paisa paise ko khichta hai is what we say in here in India. And that was true for the longest period of time. But I think that breakout out of that sort of metaphor is now beginning to happen, where you are seeing people who haven't had conventionally growth assets are now making significant amount of money. At the very top, the quantum of wealth creation is very large. When we think about our user base, which is middle class Indians, we think that in the next 10 years, they will add nearly $15 trillion of investable surplus, of which, and here is the second point, nearly 10 trillion will go towards financial assets. So now the second point therefore is the nature of wealth creation is going to be very different than the nature of wealth creation that we saw in maybe our parents' lifetimes. In our parents' lifetimes, a lot was about industrial families making money. Today we are seeing middle class individuals make money. How they manage the money will also be very different. The allocation to physical assets is going down. It is potentially today at still about 50 to 60%, but I would think this number will flip, where 60 to 70% will go towards financial assets. So the nature of wealth creation will also begin to change. And I think this is almost like a requirement in the current context, because we are heading into, if this wealth creation doesn't happen, okay, so on one hand we are all excited that this wealth creation will happen and hopefully people will manage this money well. If on the other hand it doesn't happen, we are staring at a massive retirement crisis in India, and maybe at some point we can go deeper into that. But the alternate is not a reality that we would want to live in. But I'm very excited about the direction that we are taking on this whole wealth journey.
What is the retirement crisis that you're referring to?
At some level, the part of this is good news also. Medical science has evolved. There is improving healthcare available in India. Already, the bigger cities in India have healthcare comparable with maybe tier 2 cities globally. So we are seeing good healthcare available, and with stuff like Ayushman Bharat, etc., hopefully it will trickle down to the rest of India also. Which means that once we have access to great healthcare, the next thing is that we will potentially live longer. Today, let's say if the life expectancy of a relatively affluent individual is in the 70s, there's quite likely that in our lifetime that number will be close to the 90s. So we will add nearly 20 years to our lifetimes in the generation that we are living in. Now, what does that mean? That means that if I was retiring at 60 and my life expectancy was 70, I was to live 10 years. I am now likely to live 90 years. So I'm trebling my post-retirement life. My post-retirement life was 10 years. Now it's likely to go to 30 years. So if I were to retire with 1 crore of capital, I would have probably, with some growth on that capital and netting off for inflation, I would have survived till the age of 70. But if I'm to live to the age of 90, I will need nearly 12 to 15 crores of capital. So 12 times of what I need today to retire than what would have otherwise been the case. What is the solution for this? In the West, there is social security. America has social security, and therefore, even if they run out of money, there is Uncle Sam taking care of you. In India, however, we don't have social security, and it's very unlikely that we will see social security mechanisms given the state of our overall country. And therefore, who is going to really take care of these individuals? We did an analysis and we asked this question to some of our users, that how will you survive post-retirement? 60% of them, Pritish, said that they will depend on their children for post-retirement survival, which means that India is betting on its social structure continuing to be what it is. Anybody's guess how that will play out. We are already seeing nuclearization of families happen. So given all of these multiple things, positive advances in medical science, helping us live longer, therefore we needing more capital because we will retire at the same age of 60. But on the other side, we don't have any support from the government. We don't quite likely will have a change in our social structure. It is possible that the elder generation, or as we get older, and probably you and I get older, we will probably operate in an environment where there will not be enough support for people of the age of 60, 70, 80. And that to me is the retirement crisis. In fact, even in the US, where there is social security, you are seeing already retirement crisis happen. So we are seeing that in the West, and if it happens in India, it's much more grave.
What is the importance of patience in wealth creation?
I was thinking about it in the context of my own children, and they are a fortunate lot. Like today, when my son wants candy, best he has to wait for the next weekend. And that's also a lot. Here we are living in the era of 10-minute grocery, where if I think of something now, I will probably have it in my hands in the next half an hour. What is happening as a result of that is our brains are getting wired for dopamine. We are constantly being hit with dopamine across the board. So you have a situation where you posted something online, and within a few minutes you start getting likes, comments, and so the dopamine rush, the strong dopamine rush into the brain, we feel happy in that moment. Now, the same individual, when he or she comes and talks about investing, unfortunately you can't leave that part of the brain behind. You bring that with you to your information or to your investment process. And then again, we want instant gratification. Therefore, we would like that whatever I invest in does move up almost instantaneously. You start tracking the value, and today it's become so easy to track values. I was probably in my early part of my career, I was probably 27, and in Bombay there's an area called the Parsi colony. I had ended up at this house of this very old Parsi lady, and she served me great Irani chai and said that I will show you my portfolio. Then she went to the cupboard and pulled out a set of papers. I thought she's going to show me printout of her portfolios, but those were actually physical copies of Tata Tata Group shares. There was a pre-dematting era. She said, beta, take this, or Dikra, take this home, take this to your office and calculate and come back to me. I had to double check that math on my Excel sheet a couple of times, because those rough ragtag group of papers was worth some 12 crores, and this is back in 2005 or 6. And today when I think back of that event, I think that the reason that she was able to do that or hold on to that is because she could not see the value of the asset on a regular basis, even if she wanted to. And here we are in an era where every time your stock goes up or down, you get an app notification. Your stock declares a dividend, you get a notification from the app and the bank. So we are living in a hyper information era. Now, on one hand, we are wired for dopamine. On the other hand, we are being served more of the information which is giving us dopamine hits. In effect, it is hurting our ability to stay patient. So as young investors, we are in a situation, or I'm seeing that there's a situation where people are finding it hard to be patient. So that's one reality. Now, what is the reality on the investing side of things? On the investing side of things, if you are going in assuming that the asset is going to give you returns instantaneously, you're almost certainly going to get it wrong, because a lot of these things are priced out in an efficient market. In the near term, the market is super efficient. If you look back at one of the largest shareholdings that Berkshire Hathaway has, is Coca-Cola, which they've held for 40 years, and they've not sold a single stock of Coca-Cola in that period. And therefore that compounding has played to their impact. Now imagine if Buffet and Munger had that constant instant gratification going on, that this quarterly result, this statement by the CEO, and so on and so forth, you would be incentivized to trade, and that would have hurt their ability to compound capital. So I think there is, at one level, even if somebody realizes that they need to be patient, it's really hard to be patient. It's easier to get access to investing. It's easier to figure out where to invest. It's actually harder to make money. And that's the interesting dichotomy of investing today.
As a matter of fact, Buffett or Munger and even Munish Prabhai say that the reason they play bridge or read is to distract themselves from looking at their portfolio.
Yeah.
Because they have to keep themselves busy, not to make an impulsive decision. And that is why they do talks, they encourage people to have a discussion with them, and so on and so forth. It's a distraction mechanism.
In fact, I think that's an interesting viewpoint, Pritish. And actually, I think about like really successful investors. There is a personality trait that they have, which is when you talk to a great investor, you feel a sense of calm. You know that they will not overreact, hyper react, and that's a personality trait. On the other hand, there is Jim Cramer types, CNBC, where you'll thump the table. There's one personality trait which is, let me be, I'm calm, I don't react. And even in their personal lives, in other contexts, they don't react very much, because you can't leave your personality outside the door when you enter your investing office. You bring that with you. So I think one of the key things about evaluating a great investor is, and if you get to spend time with them, to see whether they are truly that those calm people who you think will not react when there's a provocation.
Let's talk about brand building. Today, you manage 1,000 crore. How did that happen? You are in a competitive space. Usually, people with wealth want to go with established brands, but you have been able to navigate pretty quickly to where you are today. So how did that happen?
Pritish, it's been a journey. I still think about how much money we added in the last 15 days is much more than what we added in the first 2 months of our journey. Okay, and that's really, even in that like 1 odd year of our existence, you can see that compounding effect play out. And that's the thing about not only investing, but investing businesses also. One reality of our business is that trust is a super important factor, because, okay, what is dezerv at the heart of it? We are not a supermarket. We are not a market where everything is on the shelf and the investor can come and choose from that themselves. We are a place where we are telling people that we do our work, leave your money with us, and we will either guide you or manage it for you. So essentially, we are asking them to trust us almost blindly. One thing is clear, is that trust is one of those things that cannot be hacked. There is no short-term solve for trust. I meet you today, you won't trust me instantaneously. It will take you time. You will see my behavior. You will see whether I'm calm, whether I react to provocations, to news in the right way. How is my portfolio behaving over a period of time? So trust by itself is something that takes time to build. The other thing that we realize is that before you trust a brand, you trust the people behind the brand. So one important thing for us was to expose our team to the world outside, as opposed to just building the brand. Because we were quite confident that in the quality of talent that we are bringing on, if these folks, and this is not only on the investing side, but the overall company, if they talk to the world at large, we will generate trust among those who we hope to serve. And that is something that we did almost even before we launched. We wrote about how we think about investing. We wrote about how we see this current market environment, especially on topical matters, to be able to convey that how we are reacting in that situation. And by the way, most of the time the answer would be that we are not reacting to that situation. And that over a period of time started compounding. So one of the things that we realize is if we are putting ourselves out there, it creates much greater trust and the willingness of investors to deploy capital with us. One of the other areas that we were fortunate with is we come from a background of investing. We have done this for 17, 18, 20 years before we started dezerv. And to that extent, therefore, we knew that we had to operate in a regulated environment. One thing which we were absolutely clear about is we will not do anything which is outside the regulatory ambit, because in the era that we started, which is circa 2021, it was a very different world. There were a lot of new age assets that were coming up, and there was a lot of intensity and pressure on potentially offering those solutions on the platform. But through this, we stayed clear that we will focus on the regulated set of assets. And in fact, here is where the regulators also were kind enough to give us the licenses in time, and potentially because of our previous experience, we were able to get those. So I think it's a combination of many things, but I would put the patient trust building that we are trying to do at the top of it. But I think it's still a very long journey ahead. 1,000 crores is a meaningful amount. I think it's only a fraction of what we hope this business will be.
Your initial investors are top-notch venture capitalists. Why do you think they invested in you?
Again, here is where I can only speculate. I think while they've written their investment thesis around it, I think a lot of it is what is between the lines and unsaid. I'll sort of abstract away from dezerv when I answer this question, because and put myself in the shoes of an investor. What does an investor really look at when they hear a pitch? Going in, one thing is clear is that the investor already potentially has a thesis around the space that you're talking about. So one is that they need to believe that there is a secular trend playing out here, which potentially in our case is the fact that Indians are going to get more affluent and therefore they are going to put more money towards financial investing. The second is that is the approach something that can resonate within their thesis, which in our case is the fact that after a certain quantum of capital is created, you want help with that money, that you want some expert to manage it for you, because you may not have time, inclination, bandwidth to deploy towards managing that money. After that, it becomes primarily about the team. It becomes about the fact that is this the team that I can bet which is likely going to pull it off. That I would believe is something that they would look at. But one of the things that was important from our perspective, Pritish, is also like I think investors select entrepreneurs, but in some sense entrepreneurs also select the kind of investors. And for us, what was very reassuring is that there was a lot of resonance with our long-term thinking. And while today in 2022 last quarter when we sit here, this long-term thinking story is easy to talk about. In early 2021, which is when the first fundraise happened, this was not very obvious. It was about how we will crack open the market in the next 6 months, what is it that you will do? Whereas with the investors that we were fortunate to have, they understood that wealth is a business that compounds over time, and that the biggest ally that any entrepreneur can have in this business is having time on their side. And therefore having investors who understand the value of that. Going in from both our lead investors at that time, the concept was very simple. We'll build this patiently, we'll build this calmly, and that I think really helped us also. And I think for an entrepreneur, if the investor can help align with the entrepreneur's thinking, it give the entrepreneur a lot of confidence. Probably maybe I can talk about folks like us who hope to step out. One is that there is a common perception that if you're in your late 30s or early 40s, it's already too late to start up. That is not true. It is probably the best time to do it, because by that time you have the amount of industry domain exposure experience but also the fact that you have enough energy within you to pull it off. So you are, I think, at that cusp of the combination of experience and enthusiasm that you need. So that is one. The second is that the assumption that startups are only for people who are engineers or who have an experience in the startup ecosystem. That's also not true. Today, we are at a point where a lot of interesting businesses are being created by mature folks who are from other industries, from conventional manufacturing, from financial services, etc. So I think this is potentially the best time for any entrepreneur to start thinking about building a business, irrespective of their age and the background that they come. And that's what's exciting.
Previously, we have spoken. One other startup which fascinates me and how they have grown outside your domain is Zerodha. They have had quite a strong run, and it's even a trusted brand. So, what do you think they have got right?
Let's go back a few years, 5, 6 years ago, and think about the environment within which Zerodha came about. You had traditional stockbrokers where you would get, once you signed up for the account, you would have a dealer almost harass you into trading and say that here is a new tip, this is a new idea, etc. The commission rates were very high. It was almost like in some cases 50.5%, some cases almost high as 1%. The user experience was poor because you wouldn't get your statements, you wouldn't get any support from the broker when you had to file your taxes and see the portfolio, etc. And lastly, you would never hear from the broker on matters about your personal finance. And all of these four counts, Zerodha did a fantastic job. By creating a digital first experience, they made sure that nobody needed to call you. By making sure that you had access to your information at any point of time, it intuitively, inherently built trust within the user. By aligning to zero fees or zero brokerage in case of delivery and lesser number in case of trading, it seemed a great value proposition. But I think one thing that they differentiated in a big way on is the fourth aspect of educating the end user. A lot of their messaging was around, here is what you need to do, which is for you, which may not necessarily be for Zerodha or the broker that you're dealing with. And that for me is a combination that is very hard to beat. And even today, I see conventional brokerage firms trying to play catch up with that approach. And I think Zerodha is a case study in itself, therefore, that how do you differentiate not only within the product but also outside the product. And especially in investing and financial services businesses, this is something that helps build trust. And I think today Zerodha seems very large, but if you just go back even 3-4 years ago, it was not so. If you look at their growth curve, it is the classical compounding curve that we would have seen in investing, right? I would argue that more than half their accounts would have got set up just in the last 2 to 3 years, and they've been around for now, whatever, 8, 9 years. So if I were to look at their curve, it'll be that classic hockey stick upwards into the kind of a curve. So I think that is where the fruits of the effort that they've put in are now beginning to play out. We are sitting here having a conversation about investing, and Zerodha is a part of that conversation, and that's like almost a magical place for a brand to be in. So I think it takes a lot of patience, which the founders have demonstrated. They did not get carried away, and at the same time, they continued building in the interest of the user. One of the interesting things that I do see now, and Zerodha had this opportunity, they didn't take up on that, and which is why I feel I respect them even more, is in the same environment Robinhood came up. And Robinhood was encouraging investors to trade, where you would get nudges, you would get notifications, etc. Zerodha, on the other hand, didn't have much of that. And that there is the personal belief system of the founders being expressed in the product. And that something deserves a shout.
What is the nicest thing that somebody has done for you?
Wow, this is a tough one. For the purposes of this question, I will leave the family outside because obviously I think the work that, let's say, my parents did for me, coming from the back of a lower middle class background, basing on their life to ensure that I got and my brothers got the best education that they could afford, and even actually more than they could afford, I think is something that has set us up for the future. When it comes to the family, it's such an emotional thing that I will leave that outside of this answer. I think one of the things is been for me that along the journey that I've had in the last 20 years of working of my career, there are folks who have selflessly spent time with me and guiding me along without thinking of what it could benefit them and how it would benefit them. To give you an example, there is this gentleman who was potentially one of my early clients. He's a tech entrepreneur himself and he's been the tech entrepreneur of the previous IT services era. Created a company, spent many years running it, and then listed it on NASDAQ and sold it after that. The time that somebody like that has spent mentoring and coaching me to become a better wealth manager, every evening walking me through how he would think about and how I should react to those situations. Even later when I have trouble explaining a concept, I would reach out to him and say that how should I explain this, and he would spend time with me and talk to me about it. So some of these mentors along the way who selflessly, and when I ask him today as to being so busy and why would you spend so much time, he talks about the personal satisfaction that they derive from that. And that's, for somebody in the money business, it's really hard to understand too, because you put a value on the time and therefore you want to extract value from that time. So I think that for me, the mentors that we have had along our journey, I think has been one of the most interesting thing. And to me, therefore, now it almost seems like incumbent upon us to pass it along. I don't have a great construct or a great structure in which how I will pass it along. But there's this itch now that is there any way that I can help others? Because when you help somebody and that person's economic situation improves, there is a lot of lives around that person that get positively impacted and their economic situation improves, and then so on and so forth. So I think a lot of life is about improving economic situations, and through somebody's mentorship, if my economic situation improved, I think that's something that I find very amazing. Obviously, the family comes first, and the kind of effort that and sacrifices that my parents, my wife make today for what I do today or have done in the past, I think that is simply incredible. But why do you ask this question? It's an interesting one.
I personally reflect on it a lot. You are on this podcast. You're giving me your time. You're sharing your insights. I have had mentors who have, for no reason, taken time to give me insights. And by the way, even if one guy listens to this conversation that happened between you and me and inspires him or her to do something better, I am more than happy for putting in all the time and effort and thanking all the guests who have come on board.
You know, one of the most interesting things, especially, and I think about this particular podcast also, is that you are putting it out there without expecting necessarily feedback coming to you. And by feedback, likes, comments, engagement, view through rates, all of that stuff. And that's the hard part to do, because, and similarly, when somebody is somebody's mentoring me, they are not expecting anything to come back to them. The nicest things in life are those that somebody can do for you is where they didn't go in expecting certain feedback, or they didn't go in expecting elevation of their economic or social status. If I do anything to elevate my economic or social status, then that's in a way a vested interest, right? I'm doing it for a reason. And in the process, if I help someone, then it's great. But the really good things that you can do for someone is where you don't expect anything for coming back as either economic or social status. And by the way, a lot of philanthropy that does happen for social status. You would want your name on the school and so on and so forth. But I think where mentors spend time with you, they are in the background. A lot of us don't even know who they are, like who is Pritish's mentor or who is Sandeep's mentor. People don't know that, but they have a massive role to play, and that's, I think, the contribution without expectation, I think, is an incredible trait to have.
Sandeep, that's a great place to close this conversation. Thanks for being on the show.
Pritish, I've enjoyed this conversation. It's been wide and it's been deep, which is not very common, and I wish 1% Project the very best.